All right, welcome to Capital Markets Wrap, sponsored by Poly. Thank you very much, Poly. A very good product and pricing engine. If you haven't seen it, you should check it out. They've made some fantastic strides here in recent years, so if you haven't seen it for a while, definitely take a look. We have quite a panel today and a lot to talk about. So once again, thank you to Polly. And what we're going to do now is go around the horn, as they say. I'd like the panelists to introduce themselves. And then we're going to jump right into some of the topics that we've seen here in the last 30 days since our last Capital Markets Wrap. So Dawn, ladies first.
All right. Thanks for having me on the call today. I'm Dawn Meshel, EVP Operations and Enterprise Execution at Plaza Home Mortgage.
Ira.
Ira Selwin, Vice President of Capital Markets at U.S. Mortgage Corporation.
James.
Good afternoon. James Baublitz. I'm SVP of Capital Markets for First Home Mortgage Corporation.
And Mr. Kessel.
Rob Kessel, founder and instructor at Panoramic Academy.
Very good. How's that going, by the way?
That's great. We're just about ready to start another semester, and we printed some very illustrious certificates from the people who participated in the last semester, and so excited about that, and kicking a new one off right here in the next couple of weeks.
Good. And Dawn, I have a question. We're going off script right off the bat.
Of course you are. Of course you are.
You're in Arizona, and the company's headquartered in the San Diego area.
Correct.
Does that matter? Is remote work okay at Plaza?
Remote work is okay at Plaza. I would say it is probably no different than for anyone else. There's, constant struggle, and you have to pay close attention to actually engaging everyone in remote work environment for sure.
Yeah.
But
I have my boss monitors my mouse movements on my computer just to make sure that I'm still present. So
Your boss or your cat?
I was just going to ask that same question.
Both. All right. Well, there's a lot going on, as I said, and Ira, what do you want to start with? We're going to throw this open to Ira. What do you want to start with in terms of topics that you feel originators are asking you about?
Well, I think right off the bat, the most the most important one would be the Trump announcement of the $200 billion of MBS purchases. So that came out around 4:30 on Thursday. And I knew right away that was going to be something that was going to pop up on all the headlines, and originators were going to call and ask, what does this mean for rates? So I actually sent out something, early Friday morning saying, hey, here's the deal. We know the president announced these purchases. You're going to see the impact immediately. We did. We saw, a nice Friday. As for the future, it's going to be interesting to see how this all plays out. What's the pace of these additional purchases? Is it going to be all at once? Is it going to be spread out? There's definitely different impacts depending on that timing, but I think that's the most timely and the most important, conversation for right now, to start off with, at least.
Yeah. James, did you see the same thing with, in terms of rate, in terms of your originators?
Yeah, same kind of thing. And really, this was certainly a surprise. The headline here is that the Trump administration is directing Fannie and Freddie to buy, as Ira mentioned, about $200 billion in MBS. That's roughly the amount that they're permitted to buy under their preferred stock purchase agreement, PSPA. It's important to note, in my view, that the GSEs have already been buying into their portfolios. They've been doing it kind of quietly, but they did buy about $15 billion in November. So some of this has already been baked into pricing lately. I think for me, there's an interesting nuance here, in my view, namely that when we're talking about buying MBS, the GSEs generally, or at least historically, don't purchase a ton of Ginnie Mae paper. So one thing that's interesting to kind of consider is the possibility that, kind of unlike the Fed, which was buying everything, it might be possible that conventional MBS may outperform government if that persists. But net, kind of the research that I've read is when you look at the 200 billion, the impact of it, and so on. Again, to Ira's point, not sure what the timing is going to be, but it looks like it's somewhere in the 10 to 15 basis points in rate potential impact, and so on, kind of back of the envelope.
And that would be Fannie and Freddie. I would think non-agency, non-QM, DS, any non-agency securities or Ginnie Mae securities are kind of left in the dust? Or do you think that some of the Fannie Freddie or some of this 200 billion price movement spills into that market?
Yeah, I mean, I think that the Fannie and Freddie side of the house will probably take the lead on it. But to your point, certainly all these things are not in a vacuum, I should say. And so certainly you could see some spillover effects, and you could see other products kind of chasing that. But I do imagine that at least in the beginning, the price action will be concentrated in Fannie and Freddie.
And Dawn, I want to ask you, I mean, your Plaza has this massive wholesale presence. You're dealing with brokers, you're dealing with loans flowing through and so forth. Do you think that an announcement like that, brokers know about it right away and it impacts their flow of business in terms of, gee, we want a price renegotiation and so on? Or do they just kind of go about their business doing what they're doing?
I think it's both, actually. I think there's some brokers that are uber aware of it and do kind of what you're saying. They are going to ask for price renegotiations, but for the most part, nothing really has happened yet from it, but I can see that there will be some that will renegotiate. We actually had a pretty big part of our pipeline wasn't even locked yet, so we saw a little spike in locks on Friday.
Yeah, I would imagine so. Mm-hmm. And Mr. Kessel, looking at this from, you've been around the block a few times, but only going back 5 or 6 years to COVID and when the Federal Reserve stepped in and started buying securities, how is this different than that?
Well, I think it remains to be seen whether or not what the Fed does in response. Like, for example, Fannie and Freddie focus on Fannie and Freddie securities. Who knows if the Fed picks up some of the slack on the Ginnie side? What kind of messaging they have I mean, ideally, this would be less chaotic. It would be more, feathered in to where we want to have pipeline renegotiations. I'd love someone to get the memo about how much it costs lenders when they do this kind of unpredictable stuff that could, if their intent is to bring down spreads, bring down rates, create affordability. There's a way they could do this where they'd accomplish that with what, gunpowder they have without being so disruptive. So, and clearly in COVID, it was completely disruptive because of the magnitude. And I think just the fear factor of the government, their over response to, what they worried was going on, it's actually occurring. So hopefully this time around, it's, more measured. The gunpowder they have is a lot less. And it's a, metered approach to it, but, it's hard to predict what's coming next, right?
Rob, you did just make a really good point. If I can just add on to that, to your point, we have to consider the Fed side of all this as well. The Fed is currently letting their portfolio of MBS run off. But we do have, and I'm sure we'll talk about it at some point, but we do have potential for a new Fed chair as well. So to the extent that the new Fed chair hypothetically starts reinvesting the runoff, then that would amplify this purchase program too. So, and I would just also emphasize, historically speaking, the GSEs have been a little bit more price sensitive, and I think it's really worth underscoring what you just said there, which is the Fed during COVID, that was not particularly price sensitive for sure. It was more shock and awe.
I think one other important point to this whole thing is, traditionally a lot of originators focus on the 10-year Treasury. 10-year Treasury's dropping, where we'll see rates improve. But in the case of a Friday or even yesterday a little bit, where we saw MBS prices improve, we didn't see a lot of movement on the 10-year. So it's really important as an originator to realize, to the point that both Rob and James made with the spreads, that's definitely going to impact that, not to put all the focus on that 10-year Treasury in terms of rate movement.
So, Ira, if you could elaborate on that a little bit. Capital markets folks talk in terms of spread all the time. And I wanted to go to veer once again off script a little bit. How does a trader view the 2-year or the 5-year or the 10-year, and how do spreads vary? What should people on the call know about the spread? I mean, the typical question is, why are mortgage rates higher than a 10-year Treasury rate or a 30-year Treasury rate? But what determines that spread every day?
Yeah, so I mean, traditionally you've always had that sort of 150, 180 basis point spread between that 10-year and the 30-year fixed. We saw that spike, right? Especially under the last 3 to 4 years, we saw it go up to 200, 300 basis point spread, and we have seen that come back down. But when something like this comes up, where the GSEs are purchasing specifically MBS, they're not purchasing treasuries. So simple, supply demand equation, you're going to see that spread sort of come down, in which case we did over the last 2 days. So, the main focus as an originator is, again, don't pay as much attention to that 10-year as a rate guide, right? Mortgages, the prepayment speed and the length of time that a mortgage stays on the books right now is more apt to a 5-year as opposed to a 10-year. So maybe a 5-year would be something to concentrate a little more on when you're looking at rate movement. But that's sort of the guidance that I've been giving, is just try not to pigeonhole yourself into looking at that 10-year and look at sort of the bigger picture.
Yeah, I'm a big proponent of supply and demand, whether it's this or single family homes. And I wanted to segue into another Trump announcement, which was the limit on, or the proposal. It's all couched in very nebulous terms to some extent, but I think he's going to propose, or he did propose, that somehow the number that large institutions would not be able to buy single family homes. And that has all kinds of different ramifications. And Dawn, I wanted to, if you could shed your operational angle or viewpoint on an announcement like that and what impact that might have for brokers or originators, if any, really.
I think it definitely will help the, home buyers that are going up against, the PE firms for sure. I think in Maricopa County alone, I saw something that there's 93,000 homes that are owned by institutions. So, I think it should help, but time will tell on that, to be honest. Because I think people are definitely losing out on buying, primary residences for sure.
Yeah. Were you in the Phoenix? Have you been in the Phoenix area for a long time?
For quite a while.
Yeah. I know that back in, 2008, 2009, 2010, we were supposed to have this foreclosure tidal wave, and it never materialized because whether they were institutional buyers or mom and pop buyers or just, first time home buyers, they stepped into the market and sopped up a lot of the supply that was out there. And I think from an institutional buyer perspective, they've done very well in terms of price appreciation, and they've done very well in terms of rent increases over those years. So it seems like this move about institutional buyers will impact kind of the Phoenix, Las Vegas, the Sand States, Florida more than, say, James, you're up in Maryland, right?
I am.
Is there much institutional interest up there, and what did people think about the news?
Yeah, there certainly is some, and I would say less than the Southwest, excuse me. I think from my view, the reaction that we kind of had is some of the questions, some of the things that are still unanswered. And as you mentioned, it's my understanding this is mostly still a proposal at this point, but you emphasize the word large institutional investors. What does that mean? Is that 10 homes? Is that 100? Is that 1,000? The initial announcement, I believe, said that the proposal was that they would be banned from buying more. But what about their existing portfolios? That's another piece of the conversation. And I think as well, it's worth noting that the vast majority of investment properties are owned, as Don was saying, by mom and pop investors. It's easy certainly to look at the institutions, and say that, hey, they're sopping up all this inventory, but a lot of it really is mom and pop investors. I think it's over 75%, if memory serves. So it's not a massive percent of the inventory. I believe it's something like about 1 million units of single family homes across the country. And Rob, you made a good point too, is that there are some benefits, not to defend the institutions here, but there are some benefits where things are pretty good right now and home prices are increasing and the market is pretty stable. But in a downside scenario, those institutions do tend to, as you said, kind of come in and sop up supply and provide a little bit of a price buffer too. But I guess my reaction, and certainly the reaction that I've heard a lot of, is yes, they are a buyer on the margins. Absolutely, there are anecdotes of all cash offers kind of crowding out, a family perhaps from buying a home. But it's at the same time, it's still a relatively small percent of the overall market, and it's a bit of an easy target to vilify. So I think it's an interesting proposal. I could talk all day about philosophical points, but I think I don't see it having a huge impact on the housing market.
Rob, do you have anything to add to the single family home institutional investor conversation?
The only thing I'd add, I think you guys made a lot of good points. The only thing I would add is it's a local issue, like so many things are. Like there are probably communities where maybe there's a concentration of acquisition or, buy to rent kind of propositions that may, in local markets, dislocate potentially buyers or affordability. And, so to the extent that that's happening, I think that's worthy for a municipality to look at and decide if something ought to be done. But to James's point, the numbers are small on a national stage. clearly just more of a headline news cycle kind of play versus, maybe a serious policy.
Yeah. So, Rob, keeping going with that, I wanted to ask you about yet another topic that has come up, and that was just in the last day or two, and that is the capping of credit card interest, or the future proposal, or the proposed proposal, or the suggestion, whatever you want to call it, by President Trump of capping credit card interest rates at 10%. And I wanted you to put on your kind of on your supply and demand hat, global economics or U.S. economics, and what impact, is that wise, and how might it impact mortgage rates, or how might it impact mortgage rates if it goes through somehow?
I think some presidents announce things at the State of the Union, and some people announce things through executive orders. And this one seems to be pretty clear that it has to be a congressional, set of actions if anything were to happen on this front. It doesn't seem, from what I've read, that there's any probability that they could do anything about capping rates. I mean, I'd say the other side of that is, since the beginning of lending, there's been usury laws. And, to the extent there are 25% credit card rates out there, that, maybe there's some merit in looking at that part. But again, fringe piece, not like the meat of the policy. And to me, it's just, again, another kind of headline grabber without really any, solid chance of actually occurring. Economically, I'd say it's a horrible idea. Of course, you can't just set rates, right? No one on this call is going to disagree with that.
Mm-hmm.
Yeah. Dawn, anything to add to that?
No, I completely agree with what Rob was just saying. Yeah, I can't imagine that that's got any real legs to it, but good topic.
Yeah. James, Ira, anything from the originators in terms of that headline?
I would just emphasize, I think if we want to take a positive perhaps from this, I think the goal right now of the administration, good, bad, or otherwise, is to create a number of headlines with a bit of a, kind of populist slant to show energy and effort and how they're focusing on affordability. That's kind of a broad national problem. To Rob's point, if it starts working its way through Congress, I'll feel differently. But I do think that when we look at the mortgage industry and so on, you're seeing a new policy a day, a new proposal a day, et cetera. Like, clearly, affordability in all things is in the administration's crosshairs right now. And I think, we'll see. There have been rumors about maybe some other things coming. I wouldn't be surprised to see mortgage insurance premiums perhaps being discussed, or other things in the future as well. But it's clear that our industry has the president's attention right now, for sure.
That's one way to.
Go ahead, Dawn.
No, I said that's one way to put it, that our industry has the president's attention right now. Like we were saying at the beginning of the call, that, it was kind of quiet at the end of last year, but it's been noisy the first couple of weeks of January.
Yeah, very noisy. Going back to the prior topic, Audrey Boissonneau, long-time industry vet, said she just had a conversation with an economist who said that in the markets where it's an issue, it would have a very positive impact for entry-level borrowers who can't compete against a large institution. Right. I think that would be true. But there's so many things. I mean, we don't know any of the details. What is it? Mr. Kessel, I know that the Kessel estate has hundreds of homes. Are you considered no, I'm just kidding, by the way. But, what does a large institutional investor mean? And I can guarantee you that those large institutions that have interest in single family homes are busy setting up other companies or trusts or doing something that if they want to keep buying homes, they can or will, or maybe their legal teams are looking at these things. I don't know. We'll have to see. Ira, what what are originators thinking of or saying now? We've started off, it's not like there's a big difference between December 31 and January 2nd in terms of policies, procedures, products, ways of doing business, the interest rate environment in general, even though it's a new year. Where are originators' heads right now? Are they looking at Fannie, Freddie, FHA, VA, USDA products, or are they continuing to go down the non-QM path, DSCR path, and so on?
Yeah, so we continue to see an increase in that non-QM business. While I thought it would sort of level off a little bit, we're still continuing to see more and more non-QM business come through the door, taking away some of that Fannie and Freddie business, things like investment properties where you could do a DSCR versus paying 4 points in pricing adjustments with a Fannie Freddie loan. Things like that. And then we're also seeing more and more investors come out with their non-QM offerings. And that just continues to grow. Almost every week we have another announcement of, a new product announcement from one of our traditionally agency investors pushing out their non-QM products. So I think that's just going to continue to grow. And it's a nice chunk of the business right now. I haven't run the latest numbers as of today, but it's definitely expects it to be a major impact to our business.
Yeah, I know for a fact that Polly does a very good job in terms of handling this influx of business. I wanted to ask Dawn from an operations perspective. I mean, a lot of brokers once again look to Plaza as a market leader. Can you give us a kind of a behind the scenes look at rolling out? Let's say the brokers are all clamoring. I'm going to simplify this quite a bit. Brokers are all clamoring for some kind of DSCR product or non-QM or non-agency. What happens operationally behind the curtain at a Plaza Home Loans that you can share without spilling any secret sauce in terms of the decision making that goes into offering a new product and how it gets rolled out?
I mean, high level, I would say it's reviewed obviously by our secondary cap markets team, just if it's even a viable product. Kind of to Ira's point, we are seeing way more, investors entering the non-QM DSCR space and expanding their product offerings. So, I mean, we are a product lender. We have quite a few products. So we look at it that way, just start with secondary, then credit committee, and then we roll it out. I would say the hardest part truly is getting sales to really understand what the nuance is to the new product, because they either don't really understand DSCR and this is both sides of it really, right? It's on training the users just to understand what it is. And then there's always the underwriting exception and non-QM. Typically, I don't know what you guys all see, but we see it over a 35% exception rate on non-QM loans in general, just to our guidelines all the time. So
wow. Mm-hmm. James, do you concur with that in terms of?
I do. It's an exception-based product. It really is. And by virtue of being non-QM, there's always but hold on, take a look at this loan. This is actually a really good loan. And what we found with our end investors is, especially the closer you can get to the true decision maker, the credit sign off, if you will, a lot of the time they want to get to yes. And they want to get to a yes. They just want to see things like a certain way. Like there's certain things that are, of course, red lines that they will not cross. But generally speaking, kind of Dawn's point, as you look at a lot of things, the guidelines are there for a reason, of course. But when you look at, I'm just thinking of, for example, like a non-warrantable condo. Okay, well, what is a non-warrantable condo? And that could be one of a dozen different factors. And the factor in question that makes it non-warrantable might not work for building A, but it might work for building B based on the specific scenario. So in our experience, yes, it's absolutely exception-based. And really from the lender's perspective, the more that you can be an advocate and be disciplined and be putting everything in place and giving the credit opportunity, all the information they need to get to yes. Generally speaking, our experience is they want to get there. They just need all the information.
Yep, totally agree.
I would just curious, Ira, James, and Don, from what your perspectives, is there an emerging investor that looks like they might have a bulk kind of hedged product offering, and if so, like with all the idiosyncratic investor kind of guidelines, soft guidelines, how do you think about that in the context of holding on and hedging it to delivery?
You want to start there, Ira?
Yeah, I mean, we're still sticking with best efforts on these. There's just, as we were just talking, there's so many nuances to these programs and guidelines. It could be something as simple as on an investment property, short-term versus long-term rental, that causes one to fall out from one investor into another. So we're still comfortable with the best efforts execution on that. I think we're still a little bit away before it's something that we could bulk, and sort of lessons learned from 2020 and 2021. And I know obviously that's totally different environment, but we're just comfortable with locking our best efforts. And the other side of it is we're not seeing or hearing anyone sort of paying a premium for a bulk or a mandatory right now. Now, maybe if it's a larger institution that's doing more business, they would notice a pickup. But until we're sort of seeing that, we're sort of comfortable with best efforts on these.
Yeah.
I would add, and I would say, I think to your point, Ira, I think it's a volume play. How much are you doing certainly is a necessary predicate, but additionally, like the more that you can carve out more homogeneous types of loans, kind of putting aside the exception-based situations, but hey, here's my portfolio of DSCRs where they're between X and Y, et cetera. There is opportunity. I certainly anecdotally I've heard similarly in terms of there could be nice payups up there, but I think it's a question, hedging the non-QM piece is a non-trivial exercise. There's the risk that goes into it. And I really think it's just a function of, kind of crawl, walk, run, and getting to a point where, if you are doing 10, 20, 30, 50 million a month, 100 million a month of the product, can you make carves that make sense and then put it out to auction? So it's kind of my 2 cents on it.
Yeah. Chris Willoughby, who was with eResi, quite the up and coming company there, wrote in the text, eResi, we run around 35 to 45% with exceptions, more soft guideline exceptions than hard guidelines, but we typically approve a fairly high percentage. And that's what I'm hearing out there. And I hope we don't get back to, it seems like this business sometimes has a 10-year memory with in a 15-year business cycle situation. And we have, if you go back to 2005, 2007, I remember, I was running capital markets for a well-known retail lender, and you would give your guidelines to Salomon Brothers or Lehman Brothers or Smith Barney or whoever, Morgan Stanley, Goldman Sachs, and say, hey, and how would you price these? Do you want to buy these loans? Here's what our originators want. How would you price these? Help me establish a rate sheet. And then, of course, 2008 happened and everything changed. And then in 2001, was it 2001? When did the non-QM? When did most non-QM investors take a step back and say, okay, we're out of the market now at this place, too much volatility, no investor demand, and so on. Now they've come back, and I think that the non-QM investor world has a much bigger footprint than it did 4, 5, 6 years ago, and so hopefully are more stable. Dawn, how do you, when you are, when Plaza is setting rates and prices and so forth out there in the broker community, without getting too far into the details or revealing too much secret sauce, price-wise, how do you set prices? How do you established guidelines? How do you create a program, once again, for brokers that is going to appeal to them, but also be profitable for Plaza?
I mean, I don't think it's any different than for any other program. I mean, out there, I would say non-QM has said exactly what you're talking about, setting rates and pricing for it has, I'm sure that everyone else can kind of support this, but setting margins for it, it's definitely not the same as it was a year ago. I mean, now it's pretty tight. And I mean, obviously it's looking at competitors, because for a while there were very few people in this non-QM space. And now it is definitely opened up, not just investor wise, but just other TPO lenders. Like there weren't very many a couple years ago when we started it. I don't know, Ira, if James, you guys have anything to add to that, but I've definitely seen it grow. And I for sure think 2026, we will see things change in this space a lot.
Well, I mean, certainly I would echo that. It seemed like last year, in particular, the last couple quarters, everyone was rolling out an AUS jumbo product. And then in the last quarter or two, it's certainly been, oh, and we have our non-QM offering now, and so on. So yes, in terms of sheer magnitude of investors, it's a lot more to manage. To your point, when the initial sales pitch from account executives of the vanguard of this product a couple of years ago was, hey, this is a really good opportunity as rates are backing up and volume's down. This is a great opportunity to really work for something that has a half decent margin on it. And that's absolutely not the case anymore. That's certainly, again, just in terms of the sales pitches we hear, that's not at all what we're hearing these days. It's more, hey, we have this great product and it competes really well against so-and-so. It competes great against Plaza, against D-Resi, against all these other entities and so on. So it's less about margin. It's a much more crowded space. I think a lot of it has to do with people just getting used to the product and getting familiar with it. But yeah, it's definitely a trend, and it's definitely a lot different than it was 6 months ago even.
Yeah.
And just to add on to that, I think you do have to be careful, and you don't just have to sign up because ABC Mortgage rolled out a non-QM product, right? You have to realize who you're selling these loans to, that they're going to still be around when that loan closes and you have to sell it. So you do have to just still do your due diligence no matter what, because there's just, as Dawn and everyone else mentioned, there's just so many different products and programs from so many different investors now.
Yeah. Chris wrote back saying these are fully underwritten loans. No stated. Obviously, borrowers have to have the ability to repay. And then Audrey wrote back talking about exceptions. Exceptions doesn't mean risky. It simply means the borrowers have unique situations other than high credit scores, low loan to values, lots of assets. So, thank goodness we finally have a place for these borrowers who deserve decent loans without paying the crazy premium for not fitting into the GSE box. And I would say, returning here to the GSE box for a measure, I want to get Rob your thoughts on this, getting back to kind of a global situation with Fannie Mae and Freddie Mac and conservatorship and public, another republic offering, whatever you want to call it. And if you were Bill Pulte and you're looking at Fannie Mae and Freddie Mac and they're making X amount of money and they have this amount of capital and so on, and yet the non-QM ankle biters are kind of taking away some of their market share, but you think that the president will want them to go do another IPO at some point, so you want to conserve capital, but you want to be competitive. I mean, how do you think Bill Pulte or Fannie Mae and Freddie Mac or the FHA are balancing all these competing interests in terms of products and in terms of cash flow, in terms of if we lower our GSE fee or our G fees, means we'll make less money, but we'll do more volume. How do you think a director fits all that in?
Well, he's got a tough job, and I think he makes it probably tougher on himself. But so there's some competing objectives here, right? Like if the IPO is an objective, putting a bunch of MBS on your balance sheet instead of cash kind of contravenes the capitalization required for with at least from a required risk reserve amount of balance sheet required. So that's one thing that to keep in mind. And yes, they, if they buy MBS, they have that on their balance sheet. They could conceivably sell it, turn it back into cash at whatever price. So it's not like that money's gone. But so from that perspective, it seems, that they're maybe going down another path, not an IPO path, but turning their balance sheet into an active MBS purchase facility. The other thing I would say is just to kind of look at that spread that we talked about earlier. I mean, the spread from mortgages to treasuries, it's, part of it is a premium, right, because of the prepayment risk that mortgage backs have. But then there's a G fee, there's the servicing fee, and then of course there's whatever margin that lenders need, right, to stay in business, and all of those things can move, right. And so if Pulte comes back to affordability, if that's the one initiative that is going to be the most important to the administration, that G fee comes back in, right? That 200 billion of extra cash they had in part was because of a pretty healthy G fee, arguably maybe more than is needed. So, I make another pitch, as I have before on this call, that G fee remains a very viable option for them to really reduce that spread in a more predictable, I would say, higher impact manner.
Yeah, I would echo that. I mean, I think the GSEs are they're caught in the middle, right? They're trying to serve two masters. On one hand, how do we get them as profitable as possible and get the big secondary offering and the stock price up, right? And on the other hand, if the new mantra is affordability above all else, certainly, I mean, look, the 200 billion of MBS purchases helps, but certainly by far the most impactful would be to look at that G fee. G fees have done nothing but go up in the last decade, and memory serves, we're still kicking in 10 basis points to Treasury, for that matter too, from the payroll tax extension. So my point in all this is simply, what do they want to do when they grow up? What does the administration want to do? Do they want to prioritize profitability and hit some of those equity targets, which are very, very large per the PSPA, or do we want to say, you know what, we're going to deal with that later, but for now, we're going to focus on affordability and we're going to really take a hard look at those G fees, because certainly that's something that's within their control, and that's a non-trivial discussion. I'm not trying to make it sound otherwise, but that is absolutely a lever that they could pull, especially with the administration seemingly moving in pretty good step. Like normally, I would argue it takes an awful lot to get the president and Treasury and FHFA and all these other acronyms all on the same page, right? But in this particular case, maybe that's not the case.
Yeah. There's a lot of moving pieces, as they say, and meanwhile, the folks on this call, to a great degree, the capital markets folks at least, and I think the originators understand this as well, are having to figure out the best execution for these loans that are bound for Fannie Mae or Freddie Mac. And Ira, you're there in the trenches. You have various executions for a given loan. You're also dealing with a pipeline that may not have funded yet, and you may have put on hedges for those loans in the pipeline, thinking that the best execution was into a certain security, and with the drop in rate or changes to certain attributes, those loans may go into a different security. Can you explain a little bit to the folks on the call how you look at certain loans with certain interest rates and how you slot them and how that changes?
Yeah, so as a perfect example, just the other day, I think it was even yesterday or Friday, I just basically reran my best execution of my hedge pipeline. I took a handful of loans, I compared it to my Fannie Freddie pricing, and I looked at my Fannie Freddie pricing, and you could see right on the Fannie Freddie pricing, right where those note rates are that could fit into two coupons. And there were a couple of cases where we automatically floated down a borrower, because where a loan was originally qualifying at a 6.25 note rate, when you executed on that 6.25 note rate, to Fannie Mae or Freddie Mac, it was actually pricing worse than 6 1/8 note rate. So obviously, in cases like that, we're going to just automatically float that borrower down to the better execution. Works for us, works for the borrower, makes the loan officer seem like a hero. So we basically do that analysis, take a look to see if there's any loans that we can float down proactively for a better execution, both for us, for the borrower, and for the loan officer.
So that's a great suggestion in terms of the originators who are on this call to be able to ask their capital markets people, or the senior executives who are on this call to be able to ask their capital markets department, hey, the market's moved here quite a bit. Things have shifted. Does it make sense to reevaluate what's in our pipeline? Because you're right. If I'm an LO or an AE and my capital markets group reruns things and suddenly I can go from 6 1/4 down to 6 1/8 and be better off, and I can go back to that borrower and say something like that, you're a hero, right? So, James, have you seen the same thing with your pipeline at all? Has best execution changed much?
Yeah, absolutely. Periods of volatility are opportunities for that. And really, to your point, I mean, every once in a while, secondary, usually we have the reputation of being the one who has to deliver the bad news, right? But every once in a while, you can come up with some good news and help an originator save a deal before it gets to the point of needing to be saved. And it's certainly something that originators don't forget. And it's not terribly often you get to make that phone call, but when you do, it maybe helps the next one. So completely agree with that. And I think the thing that I would underscore is markets like these where volatility spikes is really where understanding the inputs makes a real difference. To Ira's point, MBS coupon spreads can widen and tighten, and differences of how different lenders value things like excess servicing, not to go too far into the weeds in particular, can make a really big difference. And I think the thing that I would underscore here is that sometimes when we look at our reporting and our risk reporting and loans are moving all up and down in different coupon, the temptation is to get a little nervous and say, hey, things are volatile and moving around. But actually, it does present opportunities like that to be a hero. But additionally, there's some secondary opportunities there too from a trading point of view as well. So my point is understanding the inputs really matters in markets like this, and a great opportunity to do it right.
Yeah, great. Well, a lot going on out there, and we've come to the end of our time here with everybody. I want to thank Polly, first and foremost, great product and pricing engine for sponsoring the show. I want to thank Dawn, new participant to some extent. I mean, you've been in the business. How long have you been in the business, Dawn?
33 years.
Yikes, Dawn. No. And Ira and James and Rob for stepping in here. And Dawn, thank you very much for joining us. I hope this is a more permanent thing going forward. And thanks for you guys, all the viewers and listeners who tuned in for the last 45 minutes. Don't ever hesitate to write with questions. And if you need anybody's email address, shoot me an email and I'll get it to you. So thank you guys, and we'll see you in a month.
Sounds good. Thanks.
Thank you.